Hey, I'm Rob the Realtor, and in today's video we are going to be talking about the 10-year Treasury and mortgage interest rates. And then at the end, we're also going to go over how interest rates affect the stock market and the real estate market as a whole. So here we go. The 10-year bond is what mortgage rates are generally tied to. So in September of last year, the 10-year Treasury was only 0.66%. Now in March, it's hit 1.55%. And if you know anything about Treasury yields, that is a huge, huge move in such a short amount of time. That's only in 6 months' time. It's gone up almost a full percent or 100 basis points. Interestingly enough, mortgage rates in September were roughly 3%, and today they're still roughly 3%. But if the rates of the 10-year Treasury continues to climb, mortgage rates are likely going to catch up and make homes more expensive. So for this example, I just want to show you how interest rates can affect prices and affect affordability. So in this scenario, buyer A buys a house for $300,000, puts 10% down, gets an interest rate of 3%, and with taxes, insurance, principal, and interest, their total monthly payment is $1,635. Now I want to show you what will happen to how much house they can afford if rates go up. So we'll take this $1,635 payment and we're going to keep that because all buyers, their qualification is based off of what they can afford every month, right? So if the interest rates go up to 3.5%, that means they can only afford a home of $285. 4% goes down to $275, and you go all the way up to 5%, $250, and if rates go to 6%, which is not, historically that's not a very high mortgage rate, that means they can only afford to purchase a home at $230,000. So what do you think is going to happen to real estate prices as interest rates go up? Prices are going to have to fall as less people can afford those homes. So let's just say that you bought a house today for $300,000, and over the next year or two, mortgage rates continue to creep up. That's going to likely put the value of your home lower and lower. So if rates went all the way up to 6%, down to $230,000, you would have lost 23% theoretically on the value of your home. So that's a real consideration as rates go up. All right, so now I want to go into the M2 money supply. This is all the money that's that's out there in circulation. So in 2008, as the global financial crisis was happening, we had $7.2 trillion out there in the world. And then we had the global financial crisis, the bank bailout, and all of that. And between 2008 and 2020, the total money in circulation went up to $15.4 trillion. That was more than double what it was in 2008. Now just in the last year with COVID, from 2020 to 2021, we've printed another $4 trillion into circulation, and that's a 26% increase just in that 1 year. So we now have $19.4 trillion out there in the world. So just to put this in perspective, between 2008 and 2021, 63% of all the US dollars in the world came into existence or were printed just in the last 13 years. So throughout the whole history of the United States, over half of the US dollars out in circulation were created in the last 13 years since the global financial crisis. And we're not out of the woods yet with COVID, so it's anybody's guess how much more money is going to get printed now in 2021 and further. I know we've got another $1.9 trillion stimulus package coming out, and a lot of people think that won't even be the last one of the year. So we'll see what type of deficits and what type of money printing we see here in 2021 and in the future. So the next section of the video, I'm going to cover the national debt and where that projection is going, and it might just blow your mind. It blew my mind, even though I knew it was bad. It's really bad. Okay, so for the next part of this video, we're going to cover the national debt. And so what I did is I just went through our last 4 presidents and looked up what the national debt was when they took office and what the national debt was when they left office, and then how much we added to the national debt every year they were in office. So Clinton, he took the national debt from 3.8 to 5.8 trillion. That was 500 billion per year. Bush 2 from 5.8 to 10.7 trillion. That was 613 billion per year. Under Obama, it went from 10.7 to 20 trillion, and that was an average of 1.16 trillion per year added to the national debt. And then the last 4 years of Trump, we went from 20 trillion to 27 trillion for an average of 1.75 trillion per year added to the national debt. So as you can see, there's a big trend here. The thing that happens year after year after year, regardless if it's a Democrat in office or a Republican in office, the national debt continues to grow. And you can make a very strong argument that neither Democrats nor Republicans want to cut spending. They just want to spend more and more and more every year to keep this gravy train going and kick the can down the road. They just want to spend the money on different things. Now, as of today, I checked the debt clock. You can go to debtclock.org on the internet. We just hit $28 trillion of national debt. So we have to pay this back theoretically, and if we have to pay that back at higher interest rates, that's going to cost a whole lot more in debt service every single year from our national budget. So that is another reason why the Fed wants to keep rates low, because we have to pay back that debt. Congress wants to keep rates low for that reason, and they don't want to blow up the real estate market or the stock market with interest rates going up. So next, I'm going to talk about what happens when the Feds tried to taper and reduce their balance sheet. So I'll talk about the Fed's balance sheet and why they can't, or probably won't, reduce their balance sheet ever again. All right, so for the final portion of this video, we're going to talk about the Fed's balance sheet. Before the big government bailout, or actually this might have been before the big bailout, the Fed's balance sheet was $900 billion. Then in 2009, after the government bailout and quantitative easing started, we got up to 2.3 trillion. I put it as 2,300 billion just to keep it in the same units. Then this is about the end of the quantitative easing. We got the Fed balance sheet up to 4.5 trillion. And then in 2018, or as they were doing quantitative easing, the Fed said, well, we're just going to do this temporarily, and then we're going to start tapering or unwinding our balance sheet and get rid of some of those toxic assets that we had to buy. So they tried to do that in 2018. They got their balance sheet from 4.5 trillion down to 3.8. And then in December of 2018, the stock market started to crash, and crash big. So the Fed then had to back up. They had to stop reducing their balance sheet, and they said basically they're not going to sell off any more of their assets. They're not going to reduce their balance sheet, and now they've reversed course, and it's now ballooned up to 7.4 trillion currently. This is probably going to inflate dramatically over the next year, over the next 4 years, and over the next decade. I don't see any way how they're going to ever unwind their balance sheet or let interest rates rise. If either one of those things happens, the economy is going to be in really bad shape. We're going to see a depression worse than 2008 most likely. Janet Yellen, when she was the Fed chair, she famously said, we will never see another recession in most of our lifetimes. Now she's getting kind of old, so maybe in her lifetime, but I think that was a pretty dumb quote that made no sense at all. And now Janet Yellen is Biden's Treasury Secretary, so she's going to be working hand in hand with the Fed to print lots more money and provide a lot more stimulus. So what can the Fed do? They're kind of stuck between a rock and a hard place. They can't really let interest rates rise because that's going to make the stock market crash and real estate market crash. So what pretty much their only solution is going to be is to get into the bond market and start buying everything. They're going to have to buy trillions of dollars worth of 10-year treasuries to keep that interest rate down, to keep mortgage rates down, and they're also going to have to go in on the short side of the curve and put a lot of liquidity into the short-term T-bill market in order to keep overnight lending rates down as well. So the end result of all this Fed injection of liquidity and money printing is the United States dollar is going to continue to lose value. So all of us, everyday people, it's going to be more and more expensive for the cost of living. You're going to see large rates of inflation, even the way that the United States government measures the CPI. And I don't think that they even include things like food or energy, things like that that are staples to what we use and have to spend money on every single day and every single week. So our cost of living is going to dramatically increase because the value of the dollar is going to dramatically decrease. So you may want to talk to your financial advisors or start to educate yourselves as to what you can do to preserve your purchasing power and hopefully survive through some rough times that lie ahead. Our national debt is going to continue to balloon. Fed money printing is going to continue to go off the charts. Our national debt and deficits are going to continue to balloon, and our trade deficits will likely balloon as well. So I hate to be Mr. Doom and Gloom, but just some food for thought. This is not investment advice, but rather just hopefully opening your eyes to some of these things and encourage you to look into these in more detail and find out how that can affect your day-to-day life and how you can help protect yourselves and your families. So if you enjoyed this video, even though it was somewhat depressing, give it a thumbs up and leave some comments down below and let me know what you think is going to happen with things like interest rates, the national debt, the Fed's balance sheet, and the US dollar. I'm interested to see what you all think. This is Rob the Realtor. Stay tuned for another video next week.